The capital asset pricing model is a model and it's a theory that relies on historical data, which means the betas may or may not actually reflect the future variability of return. So it's difficult to calculate future betas. Because of this, the required returns that are specified by the capital asset pricing model, we should use them as approximations. Also, the capital asset pricing models assume that markets are efficient and that market participants are rational and risk adverse. Although the perfect world of perfectly efficient markets is unrealistic, studies have provided some support for the capital asset pricing model. So let's do some concept checks. You have developed the following data on 3 stocks. Stock A has a standard deviation of 0.15, beta of 0.79. Stock B, standard deviation of 0.25, beta of 0.61. Stock C, standard deviation of 0.2 and beta of 1.2. If you are a risk minimizer, you should choose stock what if it's held in isolation, and stock what if it is to be held as part of a well-diversified portfolio. So you're a risk minimizer. Which would you choose? If you hold a stock in isolation, that means you're holding a stock on a standalone basis. You're just interested in the riskiness of that particular stock. Beta doesn't have meaning outside of a well-diversified portfolio. So looking at isolation, the appropriate measure for risk would be the standard deviation, and we would say that stock A has the lowest standard deviation. So if we were a risk minimizer holding a stock in isolation, we would choose stock A. Now if we're going to hold it as part of a well-diversified portfolio, then we're not really interested in the standard deviation of the individual stock. What we care about is its contribution to the riskiness of our portfolio. So we would like to choose a stock that has the lowest beta, and that would be stock B. Which of the following statements is most correct? Well, several of these sound almost right. So let's look at A. Risk refers to the chance that some unfavorable event will occur, and a probability distribution is completely described by a listing of the likelihood of unfavorable events. Well, it was looking pretty good until it said by a listing of the likelihood of unfavorable events. It should actually be by a listing of the likelihood of all events. So A is false. What about B? Portfolio diversification reduces the variability of returns on an individual stock. No, portfolio diversification reduces the variability of in a portfolio. So we get rid of the company-specific or the individual stock-specific variability. So B is false. What about C? When company-specific risk has been diversified, the inherent risk that remains is market risk, which is constant for all securities in the market. No, some stocks have lots of market risk, betas above 1, and some stocks have market risk below average, which should be a beta less than 1. So C is false. A stock with a beta of -1 has 0 market risk. No, a stock with a beta of 0 has 0 market risk. So let's see, A, B, C, D are false, so E by default, and the security market line relates required returns to firms' market risk. That's true. The slope and intercept of this line cannot be controlled by the financial manager. That is true as well. Another concept check: for markets to be in equilibrium, which means there is no strong pressure for prices to depart from their current levels, to these is true. Let's look at A. The expected rate of return must be equal to the required rate of return. That's true. If markets are in equilibrium, all information has been built into the prices, there's no pressure to move prices, then the expected return must be equal to the required rate of return. So A is true. B, the past realized rate of return must be equal to the expected rate of return. No, Past returns are no promise of future returns.